Hello and welcome to the third session of the TechnoFunda investing video series. I'm Vivek Mashrani. Today we are going to talk about a very interesting topic around support and resistance. The agenda for today is, first we will understand what is support and resistance. Then we will understand how they are formed. Thirdly, we will try to understand the underlying psychology behind support and resistance. And then we will also see how it is linked to the fundamental valuation. Now all the market activities are surrounded around demand and supply dynamics, right? All the buying which is created, all the selling, whatever market activity which we see is ultimately a derivative of demand and supply. Now support is the point, in very basic parlance, the point where the buying interest exceeds the selling pressure. That means that buyers are willing to jump at that particular price much more than the sellers are willing to sell. And on the opposite side is the resistance, which is the price at which the selling pressure exceeds the buying interest. So it is the price where people are willing to sell more rather than buyers who are willing to buy. So now we will try to understand the supply and resistance with the help of very different example, and I call it example of three monkeys of Gandhiji. And as you can see, there is a wave formation where the price is moving up, then there is a ceiling where it hits, which is known as resistance, because as we discussed, there is more supply at that point of time than the buying interest, and hence the price is falling from that particular point to here. Then again there is a change in the dynamics. The buying interest is much higher at this point than the selling pressure, hence the price is going up again. And same way there is a resistance where again the selling pressure increases and the price goes down, and then again there is a buying interest, prices going up. Now let's just focus on this particular area where there is a red dot and we have this green colored arrow signifying the movement of the price. Imagine there are three category of participants which are represented by each of these monkeys. The first category is the longs, which basically at this point, the red point, have taken a long position. Now imagine the price is going up and there is this green line which signifies that. What will happen to these longs? They will be happy, right? Because they are into profit, but at the same time they will regret not buying enough. Probably they might have just taken some small position and they might think that, okay, if the price is again coming back to the same point, I'll probably buy more, I'll add at a lower point, right? So he waits for that lower point, but right now he is happy and slightly regretful at the same time. Now imagine the second set of participants who basically shorted their stock at this red point, and since the price is going up, they are into a regret phase. And as we know that it's very easy to book profits, but it's very difficult to book losses, and that is typically known as loss aversion. So these shorts are basically thinking that let's break even when the price again goes back to the same position. So they want to liquidate their short at the point where they started their position in order to break even. So they are just thinking of buying once the price again reaches back to the red position. Now there are third set of participants who probably had a long position but they just booked profit. They are into regret because they are thinking that I probably booked the profit too early. And there are other set of participants who are just thinking that whether to buy or not, and now they are into again a regret position and they are feeling missed out, that I should have taken a long position. But now they are thinking that when it again comes back to the same red point, they will probably initiate the long position. So if you understand, all the three categories of participants are just waiting for the price to come back to the same zone which the red position was there to initiate fresh long position. The longs will add more to their position, The shorts will do a short covering and probably some of them will again initiate a long position, and the uncommitted buyers are again waiting for the buying opportunity. So this is how psychologically the supports and resistance work beautifully. If you think about the opposite principle, there is a principle known as Polarity Principle. So once this support is broken, it acts as a resistance, because that was the price where maximum activity took place, and all the participants will wait just in the opposite direction to have that price broken and go above that price. Until that, they will just be on the short side. So it's a polarity principle of support and resistance. Now if we think about the last topic, which was understanding fundamental valuation along with support and resistance. Now imagine this is a typical security, say Eicher Motors, and the middle line, which the bigger line which you are thinking is probably the price 20,000 rupees. The top line is 21,000 and the bottom line is 19,000. Imagine most of the participants are thinking that the fair value of this company is 20 times the price to earnings multiple, and the earnings is say 1,000 rupees. It's just a hypothetical example. So the price will lurk around this area whenever the fair valuation of 20 PE or 20,000 price is reached. Now what will happen if the price goes down and it comes to 19,000? Now if majority of the participants believed that the fair value is 20,000 at 19 multiple, they will think that the price is probably cheaper. So there will be more buying interest rather than selling interest, because now the price is much more attractive. So more people who think that 20 PE is the fair PE will tend to buy at that price zone, and hence that support will get created. Similarly, if the price moves to 21,000, say over here, and if still lot of many people were thinking that the fair value of this particular security is 20,000, they will start selling or start booking profit, because now they think that the price is probably overvalued and we can slowly book the profits. And this again, the phenomena of prices going above fair value and below fair value is very, very common in the market. It happens because of greed and fear. So there might be lot more euphoria at some point, which basically makes price to go above the fair value, and same way there might be certain factors due to which there is more fear, which pulls the price below the fair value. So this coincides with the fundamental theory of greed and fear, and then you can easily correlate that to the principles of support and resistance, which are predominantly used in technicals. So this is how technicals and fundamentals go hand in hand in terms of activity and behavior of market participants. Thanks for watching. Do share and subscribe the video channel.